Basically, Congress has been stealing from us for a quarter of a century, $2 trillion worth. But the other issue aligns directly with corporate pensions in America. How could it be possible that companies like General Electric had not paid 1 penny into those funds since 1987, took billions of dollars out of the pension program, and yet in 2010 they still had a surplus to handle all of their obligations for their 233,000 retirees and current employees? Keep in mind, the company took back billions from those funds to show as corporate profits and pay executive pensions. Well, it's quite easy to understand. We've just forgotten what transpired over the last 30 years. In the early 80s, America went through a vicious recession, with many companies like GE putting people of Jack Welch's stature into the top positions. Welch, in those days, was known as Neutron Jack, responsible for shutting down or selling many of GE's less profitable divisions, jettisoning 40,000 workers in a short period. It was no different than Detroit. They downsized in the early 80s, and they threw hundreds of thousands of auto workers out of jobs permanently. Moreover, the movement to accelerate the offshoring of jobs went into overdrive. First, by increasing the amount of factory jobs we moved into Mexico, and then over the past 2 decades, often to China. The net effect is that corporate America was severely downsizing during the early to mid-'80s. Therefore, the overall remaining number of workers, who were often younger, and fewer of them, they were less of a long-term liability for corporations and their pension programs. But something else happened in that period. Just as corporations were getting smaller, much leaner, those investments already made or being put into retirement programs suddenly started jumping in value to a degree that had never been seen before in our history. For one, from 1980 to 1983, interest rates being paid on cash was often as high as 15 to 20%, certainly higher than any rate of inflation. So pension funds with cash on hand were making superlative returns. Then again in 1982, the Dow Jones was around 882 points. But in time it would cross over 14,000 at one point. Therefore, $1 invested in a pension program in 1982, based on the average of the Dow, would quickly be worth $15.87, not including dividends paid over that 20-year period. Likewise, a pension plan investment of $1 in the NASDAQ in 1980, when it stood at 131, was worth $28 19 years later. Again, based on the average of that exchange, and certainly less any dividend income. So American corporations were putting aside monies for their employees' retirement, which is actually diverting current employee incomes to those funds, but they were doing so in the old-fashioned, conservative, and predictable accounting mode, the one that had been used for decades, or during a period when equity markets were infinitely more stable in their valuations. So the correct amount of money was being put aside for the pensions for millions of Americans, but the stock market started its longest and most dramatic bull run in history. And that turbocharged the value of all American pension programs. By 1999, if you took all of the pension programs in America, totaled their assets and liabilities, those pension funds had a surplus of, get ready for this, $250 billion. Of course, pension programs are supposed to have huge surpluses in good times. So when the downturns occur, they still have more than enough funds to cover their liabilities. But something was happening in the 90s that changed the equation. The incomes and stock bonus programs for executives skyrocketed. And stock option programs are only truly valuable when corporations were minting money. More to the point, corporations didn't have pension programs for their highest class of executive. Instead, they were on a pay-as-you-go system. And American corporations in 1999, they saw that $250 billion in excess monies in their pension programs, and they wanted it back. And so in November of 1999, the top experts in pensions met at the Labor Department in Washington, D.C., an agency there solely to protect the rights of workers in this country, an agency that had been overseen by Robert Reich in the early years of the Clinton administration, a well-known liberal for workers' rights. But by 1999, Clinton had installed Alexis Herman, a former beauty queen, whose commitment to the average American worker appears to have been no more diligent than Robert Rubin, Larry Summers, and others in Clinton's second term. Now, these pension experts were at the Labor Department wanting to change many of the rules covering employee pension programs in order to get their hands on that $250 billion in surpluses that had built up due to downsizing, a runaway stock market, the 1974 law demanding pensions be funded correctly, and the 1990 law that forbade corporations to raid pension surpluses by terminating those programs. On that day, in spite of the fact that many corporations had paid not one penny into their pension programs since the 1980s, a decade earlier, well, GE's pension fund had a $25 billion surplus. Verizon sat at $20 billion in the black over liabilities, and AT&T's was up $7 billion. Yet the cry that day was that it was unfair for corporations to sit by and let employee pension funds with massive excesses will allow them to simply use those funds to pay, dare I say it, their employees' pensions. I kid you not.